Welcome back to my second video, and it's going to be sort of a surface level explanation as to what you should look for when valuing a company. This is not necessarily going to be an in-depth video on financial modeling, so if you're expecting, it's not going to be anything like a DCF or a comparable company analysis, which I will discuss in later videos. I think this is going to be over quite a few parts. I apologize for not posting a video last week. I do have quite a busy schedule, so I've got other things to do. So this can take, these videos do take a while to make as well. So I'll try my best in the future to be a bit more prompt and actually get a video out. Anyway, enough of me waffling. So we'll get into it. The first question is, I'm going to say, let's say, I don't know, Aviva is worth 10 billion, for example. Not that it is, just for example, whatever next company, what are they looking at that justifies their valuation? Is it profits, brand growth, or is it something else? And why do these factors matter? Valuing a company is more than just, reviewing numbers. It's about understanding the dynamics and stories behind those numbers and how it relates to a wider market trend, or if it does at all. Where should you start? Before jumping into numbers, it's important to understand the wider context of the industry. You know, we've got to understand sort of the provenance as to the times, sort of the wider macroeconomy as a whole, in order to guide our direction when valuing a company. And it is best to compare its position to the other, competitors within an industry. So if you're looking at the value, so trying to value or present a stock pitch on Barclays, it'll be worth looking at its competitors, Citibank, um, Group, um, JP Morgan, Goldman Sachs, etc. And yeah, the subsequent slides will cover, the five following areas that are essential to factor in. I'd say this will be a brief introduction. It's not going to be an in-depth, super insightful video. Um, yeah. Okay, so this slide is going to be discussing business model and revenue quality, which is again something you should consider and something you should look out for when investing in a company or when valuing a company, should I say. So yeah, the first thing is business model. So basically, how the company makes money, uh, its main source of income, who sells it, and how cash flows through the business, basically. The second thing is revenue quality. So how stable, predictable, and profitable a company's revenue is, um, which again, are generally things you would do want revenue or a company that you're investing in to have a strong business model because it would lead to predictability, which is, generally a good thing. But yeah, key elements are sort of, what the company solves. So, for example, Aviva would be the company Aviva deals with insurance, pensions, things like that. And also, why the customers buy from them. Another thing to consider is the revenue model. So basically, how the company charges, customer base, scalability, which means, how easy the business can grow revenue without also equally growing cost. As I said before, strong business models tend to lead to predictability. Revenue quality again entails, how stable and predictable the revenue is. Some things to consider maybe subscriptions, generally are more predictable sources of income, unit economics, which is CAC, CAC, which base is stands for customer acquisition cost, so how much it costs to acquire one customer, and LTV, which is lifetime value, so how much profit the company makes from a customer, over its entire relationship. Um, and there are some other things which, again, I'm not going to go into. Gross margin strength, operating leverage. I will cover more of these in later videos, but this video is just to sort of get an overview of to how it and this matters because investors pay more for companies with predictable trends of growth. So now I'm going to talk about the financial health, which is a crucial part of evaluating any company when investing. There are three components we look at, so profitability, cash flow strength, balance sheet strength. The first thing I'm going to be looking at is profitability. This includes things like revenue growth, gross operating and margin trends, earnings per share, EBITDA, and EBIT. And essentially, we want to understand how efficiently the company is generating profit and whether that performance is improving over time. Um, if anyone wants to know what EBITDA means, or EBIT is earnings before interest, tax, debt, and amortization, and EBIT stands for earnings before interest and tax. The next thing we're going to look at is cash flow strength. Here we look at free cash flow generation, working capital efficiency, and the cash conversion cycle. Strong, consistent cash flow is important because it supports operations and helps finance future growth without relying too heavily on debt. Finally, the balance sheet strength. This includes debt levels, the interest coverage ratio, and overall liquidity. A strong balance sheet reduces financial risk and makes the company more resilient during economic problems that may arise. Um, and sort of overall analyzing these components gives a much clearer insight into a company's financial stability, and it helps us better understand the level of risk when involved when investing. Um, I think I'm probably going to sort of um, make part two to this video. I've finished some slides, but I just don't want to drag it out too long. So, hopefully I'll see you there in part two, where we will discuss some of the other things to look out for when um, being a company.